Hello, traders, and welcome back to the Forex Geek, where we dive deep into the tools that can help you make smarter trading decisions. In today's video, we are going to be talking about the Fibonacci Moving Average strategy, which is a strategy that combines the timeless principles of Fibonacci with the versatility of moving averages. This unique approach can help you identify dynamic support and resistance levels, potentially leading to more accurate trading decisions. By the end of this video, you understand how to apply this strategy to enhance your trading performance. So let's dive in and explore how you can leverage the Fibonacci moving average strategy to improve your trading results. Stay tuned until the end to learn how to integrate this valuable strategy into your trading arsenal. So without wasting much of your time, let's get started. First of all, let's understand the Fibonacci moving average strategy. It's a technical analysis tool that combines the Fibonacci sequence with exponential moving averages, EMAs. Unlike standard moving averages, this method uses numbers from the Fibonacci sequence, such as the 5, 8, 13, and 21 as look-back periods. So I'm just going to add these indicators. Just going to add the moving averages and use those numbers as the look back period. Since I'll be adding multiple moving averages, I'm using the moving average ribbon, which is this. Now we are using EMAs and not SMAs. EMAs are more weighted and they react quickly to price. So we have the first one 5. Next should be 8. These are Fibonacci sequence, Fibonacci numbers. This is 13 and this is 21. So I'm just gonna adjust the colors. 5 can be red, 8 can be blue, and this can be yellow, and this can be orange. Okay, now we can see it. It's clear, and I guess I'll use a different color here, like this one. Okay, I think red is better. All right, then the style. This is the style. I don't know. I think I should make it thicker. Should make it thicker so that we can see it clearly. All right, so the first step is setting up your moving average indicator to these numbers, the 5, 8, 13, and 21. These numbers are not random. They are not random numbers. They they follow a mathematical pattern where each number is the sum of the two preceding ones. This unique feature helps you identify key market levels more accurately. Okay, I think this is too thick. Let me just reduce it back to default. This is too thick. All right, and here we go. Okay, we need to see those sharp price movements when using this moving average. So in practice, each Fibonacci number represents a period used to calculate an exponential moving average. An exponential moving average gives more weight to recent prices compared to older prices or other simple moving averages. This means it responds faster to recent price changes, helping you spot trends early and clearly. So when you plot multiple Fibonacci EMAs on your chart, you create dynamic zones of support and resistance. These zones can help you determine where price movements might pause or reverse. For example, during an uptrend, price often respects these moving averages as support levels, bouncing upwards after touching them. And the same thing is in a downtrend. These moving averages act as resistance lines. You can see here, you can see happening here, you can see happening here, resistance lines. In a downtrend, price may go above them just a bit, but price respects them in the end. You can see happening here, using these lines as dynamic resistance levels. Okay, So in short, the moving average strategy gives you a structured way to analyze market trends by combining the responsiveness of EMAs with the strategic precision of Fibonacci numbers, to put it simply. So understanding this concept thoroughly will allow you to make better informed trading decisions. So let's quickly hop on the charts. Let's quickly figure out how to trade using this strategy. How can we trade using this strategy? So the first step is to set up your chart, which we have done. And the next step is to identify the trend. Are we in a downtrend or are we in an uptrend? In this case, we are in a downtrend, so we should be looking for bearish trades. So once price touches or comes close to these EMAs, look carefully for a clear bearish candlestick pattern. Uh, this is the first step. Remember, should look we are in a bearish trend here. So once price comes close to these EMAs, we should look for bearish candlestick patterns to trade. And also another strategy you can use is if the EMAs are sloping downwards or upwards with the 8 period EMA, for example, in a downtrend, if the 8 period EMA is below the 13 period EMAs and the 13 period EMAs is below the 21 period EMAs, then you are in a downtrend, a clear one. For uptrends, if the EMAs are sloping upwards and arranged clearly with 8 period EMA above the 13 and above the 13 is above the 21, it means you are in an uptrend. Now they have to align uh, accordingly, just like we have here. You can see the 5 below the 8, and just like that. And the 5 below the 8 below the 13 below the 21. And this can signal a sell trade. And we should look for bearish candlestick patterns or chart patterns which we can use to take trades entries. If you can't find any one here, you could just use the break of market structure here to take your sell trades and your stop loss above the high and your take profits at significant risk reward ratio like the 1:2, and that's how we were able to take this trade. Now we switched bearish again. You can see the crossover happening here, and you can see all of them are arranged: the 5 below the 8, 8 below the 13, 13 below the 21. And so we could look for price candlestick patterns which we can use to take sell trades. We have some happening right here: bearish engulfing candlestick patterns happening here, and also rejection candlestick patterns there. So we could just look to take our sell trades at this area, and our stop losses, our sell trades here, our stop losses, we could set them above this high, and our take profit could be at levels like this one here. Remember, we are in a downtrend. Okay, sorry about this. Okay, this is where I was explaining. So remember, our stop loss should be above this high, and our take profit levels could be at this level here, which is a significant support level, all the way down. Or you could just like get a 1:2 risk reward ratio. So this is for bearish trade examples. Let's look at bullish trade examples. We have one forming here, the crossover happening here, and we have the 8 period above the 13 above the 21, and the 5 above all of them, just like we can see. And the next thing is to look for price action. We could either use the market structure shift to the upside, or we could use rejections from this moving average price using the moving averages as support. We just look to take buys from here. I like to take buys from that MSS, and you can see that was resistance turned support here, so our buy entry could fall in here, and our stop loss below this low. And we could look to target a significant risk reward ratio like 1:2 or 1:3. Remember, we are in a bearish trend, and if you draw down this trend line, we could just look to take our trades back to the trend line, and that is a 1:2 risk to reward ratio. Price has broken our trend line and we are still bullish. So we have the arrangement here again. So we could look to take another buy entry from this MSS, or we could wait in a minute because this is kind of like ranging. You shouldn't be taking trades in ranging markets. So we have the alignment happening here. We have the crossover, and spotting the crossover, the next thing is to look at price action, market structure shifts, and you have one happening here. So you could look to take your sell. If you're an aggressive trader, you could enter your sell here, or you could shift all the way here where we had the retest of that support tone resistance. Stop loss above this area, and take profits all the way down to significant support levels like this one, or you could go all the way down. So it's a straightforward strategy. We have so many examples which I'd love to cover. We have one here. We have one here. It's about riding prices, scalping from one area of support to another area of resistance. So by following these steps, you'll be able to trade a structured approach using the Fibonacci moving averages. You can trade with clarity and consistency. Remember to practice the strategy thoroughly on demo account first before applying it to live trading conditions. If you found this video helpful, don't forget to like, subscribe, and turn on the notification bell so you never miss out on more trading tips and strategies. Thanks for watching, and I'll see you in the next video.